facilitator for this next panel, Mr. Fabrizio Bresciani, the lead regional economist for Latin America and the Caribbean for IFAD. Over to you, Fabrizio.
Thank you very much, Frank. Should we wait until all three panelists are okay? So no need to explain the importance of reaching financial services, the midstream of Agri-SMEs. We all know this is important and it's a key priority. So the panel that we are having here today is actually going to give us a few examples, 3 cases, of how organizations or companies are trying to reach this underserved segment of value chains, right? Which are key to the broader transformation of agri-food systems. So let me introduce to you the 3 panelists. First one is Mr. Hari Rajagopal. He's the group treasurer and head of strategic alliances at Samunnati. He's a banker by profession and has a rich experience of nearly 15 years. He's responsible for raising all funding resources, developing access to different pools of capital for customers in agri-value chains, and forging strategic partnerships with other like-minded agencies. He had a prior experience with Rabobank and the Dutch Food and Agribusiness Bank in various capacities, in corporate banking, structured finance, capital structuring advisory, and microfinance. Then we have Patricio Williams Becu. He's an Argentinian entrepreneur with a strong entrepreneurial focus. He's founder and CEO of Pago Rural, an inclusive land and pay platform specially designed for underserved farmers and distributors. Pago Rural helps farmers finance operations in Argentina, Uruguay, and Paraguay. Finally, we have Andrew Ahiaku. Andrew is a food and agricultural finance specialist. He's passionate about inclusive agriculture and access to finance. He leads Aceli Africa's engagement with commercial banks to increase their lending to agricultural SMEs. He also supervises capacity building for both SMEs and lenders. So, welcome. Good to have you here with us today. Thank you for making time to join this panel. So we would like to invite you to give your presentations. Remind you of the importance to be within the time limit of 7-8 minutes. I will be quite strict on the time. Maybe we can start from Andrew. Would you like to go ahead and give us your presentation?
Thank you, Senior, for inviting me to this program. I'm struggling to share the screen from my end, so I'd ask Fabiana to assist with that. Otherwise, one of my colleagues could take the lead and then, okay. So as you may have heard already, and Jean-Marc also alluded to, Aceli is a market incentive that focuses on supporting financial institutions in East Africa to increase lending to agricultural SMEs. The focus of Aceli is on the missing middle. And so our focus even goes lower than what Jean-Marc had mentioned. We look at $25,000 up to $1.75 million. Next slide, please. So at Aceli, we try to understand why lending is not going to agricultural SMEs. And a research we carried out, supported by Dalberg, showed that lending to agri-SMEs, especially in East Africa, in our focus market, is twice higher than expected or compared to other sectors, and the returns are 4 to 5% lower than expected. 50% of these low returns is attributable to the cost of reaching out to agri-SMEs, which most of us gathered here agree that most of these SMEs are in the rural areas, and therefore reaching out to them is a big challenge or a big problem. Next slide. Now, leaving the situation as it is, or leaving the status quo, you will notice that the cost of serving the agri-SMEs far outweighs the revenues, and it makes lending to these agri-SMEs largely unprofitable. The lower you go, the more unprofitable these segments are. And so at Aceli, next slide, at Aceli, our focus is to use financial incentives that drives impact to make a difference. And so with these impacts, we expect that it will improve the profitability of these SMEs, next slide, and overall and over time, the markets become more efficient, and so the cost goes down, revenue goes down, and therefore the need for incentives will also go down. Next slide. Please go ahead, please. Next slide. So Aceli, in summary, is a data-driven organization that provides incentives at market level and focuses on impact. Currently, our impacts are around gender inclusion, food security and nutrition, climate and environment, and youth inclusion. For each of these impact areas, Aceli rewards the lender for supporting SMEs that meets our strict impact criteria. And this is what improves the profitability of the SME. Next slide. Aceli focuses on 4 areas. It strengthens the enabling environment, focuses highly on impact, increases capital supply using financial incentives, and addresses the addressable demands by providing technical assistance to SMEs and capacity building for lenders. So all these 4 pulled together is what makes Aceli a unique model in the East African market. Next slide. Our targeting strategy is we are not everything to all men. Our focus is on SMEs. And for a qualifying loan, it has to be between 3 months to 5 years. We're market driven, and therefore the facility must have an interest component. For the loan amount, if it is to qualify for origination incentive, it has to be between $25,000 and $500,000. And for the portfolio first loss cover, it stretches up to $1.5 million. The purpose of the Aceli loans are mainly agriculture, and for borrower impact, the SME must have a minimum revenue of $50,000 up to $3 million if it is to qualify for origination incentive, or stretched up to $10 million if it is to qualify for the first loss cover. We also ensure that the SMEs are at least buying from 25 smallholder farmers or selling to 100 smallholder farmers, or at least have a minimum of 5 full-time employees. If the loan is to attract the high impact bonus, then it must meet our food security, gender inclusion, climate and youth impact criteria. We also have exclusion zones that we consider in determining whether a loan qualifies or not. Next slide. So in your short are the Aceli incentives. The incentives are broken down into 2, the portfolio first loss cover and the origination incentive. So as a baseline incentive, an SME could earn for the lender 4% at the baseline, an additional 2% if it is a new borrower, and 3% if it meets our 4 impact areas that I had mentioned earlier. So a lender, an SME could earn for a lender between 2 to 9% of the loan value, and this goes into a reserve account. In the event of a default, then with approval from Aceli, the lender claws back the outstanding principal on the loan. On origination incentive, which targets to reduce the transaction cost, Aceli pays a lender $6,000 for baseline incentive, an additional $4,000 if it is new, or if it meets our impact criteria, then for each impact area, it will earn an additional $1,500. And all this is aimed at improving the profitability of the lender. Because as you would have heard earlier, lending to smaller entities in the agri-SME value chain is not profitable for most lenders. Next slide. So these are our metrics. We have 25 active lenders. 50% of this are from the global social impact category, the likes of Altafin, Incofin, etc. The other half are local commercial banks. Since launching in 2020, we have capitalized 77 million, and the leverage ratio is 11 times, which is over and above what pertains in the industry. According to Convergence, the leverage ratio is 4%, and for Agri, it is even lower. And so,
Andrew, sorry, you have less than a minute to wrap up, and then also your image is freezing. Perhaps you may want to switch off your camera.
All right, then move to the next slide, please.
Everyone, general freezing.
I've gone off camera. Is it still freezing, please? Okay, I guess we can turn over to the next presenter, and if there's opportunity, I could respond to questions.
We can hear you, Andrew. We can hear you, Andrew.
Yeah, I had asked that they move to the next slide, but it appears we are still on the...
Andrew, if you can hear me, hold on, please, because we're having a little bit of a problem with the internet here.
Okay, thank you.
Just a second, we're trying to bring you back to... Okay, sorry, in the meantime. Okay, so we have this screen that's working. Okay, sorry, we have... Andrew, can you hear me?
Yes, I can.
Okay, now your voice is coming through. We can listen. We can hear you well. So, if you would like to wrap up your presentation, we lost you when you were explaining your business model. I think this is the one of the last slides that you have. If you can, in 30 seconds, let's say, wrap up your presentation, please.
All right. So from my end, I can see the metrics slide, and I was mentioning that we have 25 active lenders. 50% of these are from the global social lender family. The others are local financial institutions in the 4 focus countries where Aceli operates. Since launching in September 2020, we have capitalized $77 million with a leverage ratio of 11 times, which is over and above the industry standard. According to Convergence, we should be at 4 times. The next slide is on the challenges. Aceli is heavily data-driven. Next slide, please. Aceli is heavily data-driven, and so we require benchmarking data from our partner financial institutions. They do monthly loan reporting as well as annual benchmarking, and this is a big problem. Aceli is now into the third year, and so we suffer from the startup effect. If you intend to onboard a first tier commercial bank in East Africa, the process can take anything between 3 to 8 months. And so the onboarding process is quite lengthy because of their due diligence and legal and compliance constraints that you have in country. The overall effect is because Aceli is a unique model, we are providing financial incentives, offering technical assistance, improving the enabling environment, and we like to describe ourselves as a learning organization. We have come up with interesting publications, even in this our young life. Some of it are the constraints that we have identified as a result of regulatory challenges. And so this has endeared Aceli to our stakeholders, including lenders, and we are making inroads, although we are a young organization. Thank you.
Thank you very much, Andrew, and apologies for the technical glitches here. Okay, let's move to Hari. Hari, if you'd like to project your presentation.
Yes, please. I'll just do that. Just give me a moment.
Okay.
Can you see my screen?
Hari, you have 7 to 8 minutes. So let's give your presentation focus.
That's right. So just sure. So just walking you through a presentation with Samunnati. Samunnati is an agri-value chain organization that exists to make markets work for smallholder farmers. And we try to address the market failures which are holding smallholder farmers back from getting a higher slice of value in the overall agri-value chain by making the agri-value chain operate at higher equilibrium. This means higher equilibrium can be obtained by access to more working capital by actors across the agri-value chain, as well as more market linkages, more buyers and more sellers.
Hari, sorry if I interrupt you. You're freezing as well. So perhaps you might also switch off the video, hoping that this will help. And let's see if it improves also the quality of your voice. Yeah.
I'm sharing my screen. Will that be okay?
Yeah, perfect.
Sure. So here are the scale presented so far, which we've reached so far. We've deployed over $1.5 billion in gross transaction value. That will mean about $1 billion of lending and about $500 million of market linkages. We work across the length and breadth of the country, the Republic of India, and we work in 22 of our 31 states. And we work with both sides of the supply chain. 3,000 farmer collectives with a collective farmer base of 6 million farmers, and 3,000 agri-enterprises who work on the demand side of the value chain, from the farm gate to the food plate, who are MSMEs, traders, processors, distributors, or any other agency that moves produce, adds value, and transports it towards the end customer. And we have about a $200 million assets under management and a net worth of $70 million. Of course, just some of the large investors who are on our equity cap table, as well as some of the lenders, and so the large international lenders who have worked with Samunnati, large global banks, as well as DFIs. But the way Samunnati operates is we work on what we call the B2B2C method, largely because working with disaggregated Indian smallholder farmers, all 120 million of them, is simply too expensive to do on an individual basis. It's time, cost, scale, insensitive. So you cannot grow viably by engaging farmers individually, and therefore working with farmers on what we call a B2B2C model, where we operate through aggregators, through agri-enterprises, through farmer producer organizations or farmer cooperatives, or through individual farmer entrepreneurs who are working with, say, 200 to 300 farmers. So, the first way of tackling the Indian market's challenges of scale and disaggregated land holdings is by working through aggregation models. The second challenge is how do you underwrite farmer organizations and MSMEs who, as Andrew said, have very little capital, very little collateral, very little track record in terms of past financial history. And that's where Samunnati has developed its own unique model of leveraging the social and the trade capital between the buyer and the seller. Social capital being leveraging the soft information, the vintage of engagement, the reputation of the buyer seller, and trade capital is a transaction history of volume and value of payment terms and compliance with them. And therefore, we are able to use these inputs which are available rather than the formal financial history only to provide access to credit and access to market linkages, which makes us an internal value chain player rather than a mere lender. We work on both sides of the supply chain, and we work on both dimensions of the market, which is both on the lending as well as market linkages, which makes us India's first and largest agri-solutions platform, which not only facilitates trade between parties but also provides the credit for it, which makes us a very unique organization in the Indian landscape, which is addressing the holistic ecosystem requirements of the agri value chains by providing both the market linkages and the accompanying credit. Now, to just deep dive for a minute into what some of the offerings are, where we have structured bespoke products for both customers on the FPOs as well as the agri enterprises, is that we largely work on the accepted bills, where we try to provide bill discounting or receivable financing products. So a large proportion of the products are post-harvest. And on the pre-harvest side, we are working with farmer collectives on providing procurement loans for procuring the output from the farmers, as well as providing input loans for providing inputs to the farmers and purchasing them from the farm inputs distributor. And because we work through aggregation models, we are able to harness the economies of scale, which come from collective marketing and collectivization of the farmers, and as well as we're able to utilize the usually better credit risk of the buyer while we are lending to the seller. And that's a brief snapshot. And of course, these collaterals will be available for general circulation. These are some of the products which help us de-risk working on social capital, working on trade capital, and working on cash flow focused products which leverage the power of aggregation rather than focusing on collateral driven underwriting. For working with the farmer collectives, we've also developed a very bespoke FPO grading tool to grade farmer producer organizations on their governance, compliance, outreach, management, and their impact. We're akin to the work in the microfinance sector 20, 25 years ago, where you cannot rate FPOs, but can we grade them? And we have 5 grades which are on your screens. And we've also developed specific areas of focus that allows Samunnati to harness its value chain expertise to make better lending decisions by having sectoral experts and research teams that work across fresh, livestock, food processing, the farm inputs, and the staple commodities space. Of course, we've also taken an approach to climate smart agriculture, where we've kind of done an in-house deep dive into what are the climate smart agricultural activities across the value chain, therefore identifying opportunities to not only de-risk our customers' activities, but also to de-risk our lending and market linkages portfolio in the process, because reducing the customer's risk reduces our lender's risk as well. With the result that nearly 13% of our disbursements are in the dimension of climate smart agriculture, both across agri enterprises as well as FPOs. We've also, to reduce risk and overcome the challenges of the space, opted for various credit guarantee programs with the large DFIs, whether it's the overseas US Development Finance Corporation, Rabobank, or the USAID, where we've taken credit guarantees of nearly $35-40 million, where we are giving money, giving loans to farmer collectives for gender finance, as well as for themes such as clean energy and food loss. And with great utilization figures, which makes us the largest originator and distributor of such loan assets. We've also been helped by various thematic liquidity, which we've used from some of the DFIs you saw in the earlier slide, where we've raised impact bonds and green bonds that make longer term liquidity available at competitive costs. And we've totally raised about 90 and now $100 million of foreign currency loans and debentures, both in the form of foreign currency term loans as well as non-convertible debentures. So, in our vision, is that given that markets are failing not necessarily only because of an access to finance issue, but also because of the absence of market linkages, and one feeds into the other, our view is that we have to take an agri-ecosystem view where credit is a key success factor, but we also have to keep an eye on the market linkages. And therefore, by working across the value chain with our network straddling farmer collectives, agri enterprises, and innovators, we are able to develop a model which has a repayment efficiency of 98% and a credit loss of 2%, but also provide credit to institutions as nascent as a few months old to enterprises that are as large as a few $1 billion in turnover. And together, with the value chain approach, we are able to push more credit into the agri ecosystem and in a more customized, bespoke, and cash flow oriented manner that is a departure from the traditional norms of credit underwriting and is more relevant for the system we work in. I'll stop here. Thank you.
Okay, thank you very much, Harry. Patricio, your turn.
Hello, how are you doing?
Yes, we can hear you well.
Okay. Well, we're here from Uruguay in Latin America. I'm going to tell you a little bit about Pago Rural, our farmer financing platform. We're tackling an opportunity of more than $100 billion in lending in the whole of Latin America. Just to put this in place and for you to imagine the target market we are heading, imagine an average farmer in Latin America investing $1 per hectare per year. Okay, from that dollar, on average, 50 cents are provided by input suppliers or off-takers, 20 cents provided by traditional financial institutions, and 30 cents on a dollar its own equity. This 50 cents on a dollar provided by non-bank lending is Pago Rural's target market and accountable for more than $100 billion opportunity. What we've done is a tailored lending solution in which we want to have long-term sustainable impact in the value chain in the whole of Latin America. Where we see our strongest impact is in a broader access to financial services for the whole of the value chain, which is 90%, which 90% of it is SMEs, okay? This is something very little people know is 90% of the farmers in Latin America are small and medium enterprises, which make it very easy for us to target them in the agricultural value chain model we've put in place with Pago Rural. Our proven execution in Argentina, we've done more than $21 million in credits. The ticket size and the smallest and biggest tickets show you we work for the whole of the value chain. We work with very small farmers. The smallest invoice we financed was $35, and the biggest invoice was $2.6 million with an average of $68,000. Okay, we collected 100%. Only have a small NPL, but that was insured, and we also helped the insurer recover from the farmer, being very successful in a turmoil macroeconomic system like Argentina. We see three main problems here that we're going to address. How do we tackle them? How do we get to the last mile? How do we ensure that or make it scalable and investment grade for institutional investors who are the ones in the last case available to provide the liquidity and the price needed for that money for farmers to get the loans. We're not a very profitable ecosystem compared with retail finance, for example. So that's something to tackle. Well, number one, fintech as an enabler. We have a platform very well designed. In 3 clicks, only 3 clicks, you can finance an invoice as small as $35, as an invoice as big as $2 or $3 million. I think that's very well needed, and that's a success from my point of view. You can do it from a farm, you can do it for wherever you are, and we've designed a platform to be really accessible for the farmers we are serving. One example of that is what we do not have a native app in iOS or Android. Why would we don't? Because our farmers are usually on a desktop, sitting in their farms with very low connectivity in many cases. And another thing is, for example, the second factor authentication is an SMS. We're in 2022, but in the rural areas where we work with, many times you don't have 4G or 5G or good connection. We have an SMS, second factor authentication, and many or most of our clients have smartphones and cell phones to work when they are in rural areas. How do we get to the last mile? How do we serve all those farmers spread in vast areas in Mexico, Brazil, Argentina, Uruguay, and Paraguay? We do it alongside vendors, okay? Like Corteva, Bunge, Pioneer, Don Mario, people that are already present in the last mile and are the ones serving those 50 cents on a dollar, which is Pago Rural's target market. Another important thing here is we really like to say that to address underwriting in agri, it's a lot of confidence there. The balance sheet do not always reflect the reality of a farmer. Track record does. We are provided track record for the last 3 harvest season by all of these vendors. And on the other hand, it's good for us to work with. Yeah.
Sorry if I interrupt you, but the screen here went off. So yeah, but not everyone can see. Is there a way of reconnecting the larger screen? Okay, Patricio, sorry, hold on. We have a technical glitch here. Okay, we're back to normal. So, Patricio, sorry, if you want to, we lost you perhaps the last 10, 20 seconds.
Okay, what I was telling you is it's important for us to reach the farm in the last mile with a person of their confidence. Who's that person? The salesman from Corteva, from Bunge. When we do underwriting in agri, it's very important to have track record and confidence in the farmer who we are financing, okay? In the end, it's very difficult compared to other sectors to tap on balance sheet with who not always show the reality of the farmer. And doing a good underwriting, it's important to be alongside key people like the vendors we work with. Another important thing is how do you structure and mitigate risk in these portfolios, okay? As I told you before, you have to go and tap and tackle institutional investors who are many times very far away. For example, we had a great facility in place for Argentina from a Swiss fund of $100 million, okay? It would have been very difficult for us to do so if we worked farmer by farmer on the underwriting. But in the end, what we did was work with great insurance companies, insure 100% of the portfolio, and step up for an investment grade paper for the investors to chip in. In the end, you're financing very small holders, very small farmers, medium farmers, but with a structure that allows risk mitigation and structuring attainable by institutional investors. So that's all. I did it quickly to leave you time for Q&A.
Great, thank you, Patricio. You really stay within the time limit. So, okay, I think this was quite interesting. You have 3 different type of models of how to reach or stimulate the financing of unbankable, what we refer often to times as the missing middle. I think we have about, Frank, correct me if I'm wrong, we have about 10 minutes for Q&As. So perhaps we can open to questions here from the floor. So one, 2 and 3. Okay. Okay, right. So there is also the possibility for those that are participating from remote to actually put your questions through the platform. Do we need to be more specific about how they're going to do it, or? Yeah. Okay. Okay. Let's start here from Mexico then.
Hello, my name is Patricio from Noop. I have two questions. One is for Harry. You were talking about how you're reducing risk for farmers through smart agriculture. Could you make some examples and also talk a little bit about the terms of this financing, so 10-year interest rate, and also to access this type of credit, does the farmer need to have taken other short-term loans before? So if you can comment on this a little bit. And the second question, very short, is for Patricio. If you can mention the vendors that you work with in Mexico. Thank you.
Okay, thank you. Let's take another couple of questions from here from Mexico. In the meantime, let's see if there are also... Let's go forth.
Thank you. My name is Juan Navarrete from Fundación Capital. Thank you very much. I would love to, if it's possible, to have the presentations for the audience because they were all very interesting. So congratulations. I have a question to Patricio. Do you leverage rural non-bank financial intermediaries networks as shortcuts to access Agri-SMEs? They usually have the knowledge of the different small producers in the field. So to what extent have you considered leveraging this knowledge as a bridge and considering them as part of your network of vendors? Thank you.
Thank you. Let's take one more, then we go for a second round.
Thank you very much. Good morning. My name is Hernan Manson from International Trade Center and also SAFIN Steering Committee member. My question is for Patricio. Thank you very much for the presentation. 2 points. You are collecting a lot of data. Who owns this data? And are you integrating the selling of the data as part of your business model? That's one. And then the second one, you're talking about the last mile and you spoke about vendors. This is very clearly understood. Are you also partnering with farmer organizations or credit union cooperatives in your business model as a way to also reach this last mile? Thank you.
Okay, I hope you are taking notes of all these questions. No, there is, before Frank, still no questions from other participants, right? No.
Yeah. Hello, I'm Diego Gomez from El Salvador. Also, my question is for Patricio, and this has to do with a couple of things they have said before. First, what is your perception on how is going to be the regulatory framework? And here we're talking about, well, you mentioned compliance, but already Hernan said something about data protection, but also about financial consumer protection. And in the other hand, do you see like you are helping to create a change in the way that the rural sector is feeling regard to innovation, or do you still feel like there's a gap that needs to be addressed, not only by the private sector, but from the public sector?
Okay, thank you. Frank?
Yeah, thanks. Question for Andrew. Andrew, if you could specify a bit clearly what, in terms of the scale that you've been able to achieve in the short time in the Aceli history, specifically related to the number of formal financial institutions that are actually lending now as a result of the incentive scheme from Aceli. And depending on that result, if you can comment, are there any particular challenges that you're facing in relation to the financial institutions onboarding in the Aceli program? Over.
Okay, thank you very much. So if you'd like to answer the questions, maybe we can start from Harry.
Sure. Be happy to answer the question. I think the question was on climate smart agriculture and how have we defined what is climate smart. And there are two or three ways in which we've tried to support climate smart agriculture for farmers. The first is support working capital for value chains that are better for the farmer from an income perspective as well as from a carbon footprint, which means farmer organizing
Hari, sorry if I
millets,
interrupt you, but
soybean,
Hari,
pulses,
Hari, sorry if I interrupt you, but then your voice is not coming through very well, and you are freezing a little bit. Perhaps could you please switch off your camera and start all over again?
Sure. So the first way in which we are supporting climate smart agriculture for farmers is by supporting the working capital of those value or resilient to climate change. These could be value chains such as millets, pulses or lentils, and soybean and other oil seeds, which have a far volume, such as paddy or sugarcane. And this is particularly important for a water stressed country such as India. So the first is we support working capital in these value chains. The second is we support farmers to buy milk animals which are, say, indigenous varieties and not the hybrid varieties, which are more resilient in terms of their productivity and yield with the vagaries of climate change. The third is we are supporting the sustainable equipment like solar powered dryers, solar powered processing units, micro cold storages, and other farmer level equipment or farmer cooperative level equipment, which is not powered by fossil fuels but powered by renewable energy. So we are providing the asset finance for that. So in a way, these are three themes of climate smart agriculture that Samunnati is supporting. Now, in terms of the tenor of the facility, the second question asked by the lady, uh, the tenor would typically depend on the overall transaction and the value chain. Tenor could range anywhere between 30 days to even 180 days, depending on the nature of the loan, input loan, or procurement loan. In terms of an asset finance, it could be as long as 18 to 24 months. And these could be loans that are repayable in bullet or repayable with an EMI, an equated monthly installment. And therefore, the interest rates for these facilities would also have a wide range, ranging to say 13 to 14% per annum, to all the way up to 20-21% per annum as well, depending on who is the borrower, what are they borrowing for, what is the value chain. And often these are benchmarked with not only other formal financial institutions, but also what is the opportunity cost of this working capital if it would not be made available. And therefore, given the short tenor of most of our loans, there is a fair amount of flexibility from borrowers on the interest rates because the availability of capital and therefore the opportunity to make an economic profit from the activity is more important. So that's a broad spectrum of terms of our credit facilities.
Okay, thank you very much, Hari. Andrew, and if you would like, Andrew, to keep your camera switched off, perhaps that reduces the risk of...
Yes, thank you. My camera is off. So in this 25 months that Aceli has operated, we have 25 active lenders. As I mentioned in my presentation, 50% of this belong to the CSAF community or the global social lenders, and the other 50 are local lenders in our focus countries, Kenya, Rwanda, Tanzania, and Uganda. One significant challenge in onboarding the lenders is around meeting the compliance and legal constraints, especially for the tier one banks. You have to go through several barriers of due diligence. And sometimes, as I mentioned earlier, this can take between 3 to 8 months, in some cases beyond a year. What that means is it is easier to onboard a tier 2 or a tier 3 lender as opposed to a tier 1 bank. Generally, it is difficult. Another challenge is the way the Aceli model is structured. You deal with different constituents of the bank. And so at first instance, you might engage the C-level executives, get their buy-in, but there are different constituents who will implement the model. And so you have several rounds of engaging personnel in the bank, probably 3 or 4 times at different level before you get traction. Another challenge has been around data provision. Aceli is heavily data-driven. All our decisions are based on data. And if most financial institutions also cherish their data. So getting them to part out with data sometimes can be a challenge. However, things have worked well. And as I shared, 25 are active. We have onboarded an additional 10 within the last 6 months, and we have another pipeline of 15 we are working with. So the interest for Aceli is growing, and we see more additionality coming our way. So far, of the lenders that we have supported, 50% of them are new borrowers. This means they have never borrowed up to $25,000 before in the last 3 years. And we think this is a remarkable performance, in addition to the impact that we are making in the space of gender, food security, climate, and youth inclusion. Thank you.
Okay, thank you very much, Andrew. Patricio, you had a number of questions, but if you could keep your answer down to 3 minutes because we are running a little bit late.
No problem. Question number 1, which vendors we're working with in Mexico? We're starting up in Mexico and Brazil in the next 90 to 180 days. So we will be working with the same vendors we did in Argentina, Nutrien, Corteva, Bunge, and maybe others like Syngenta and Biocrop Science that we are working with. The second question was, if we do finance intermediaries or people in the middle of the value chain, yes, we do, but we go to the last mile with these big corporations. One of the things, it's a challenge in Latin America, for example, is working in hot areas, no? With that regarding compliance, KYC, AML, etc. So for us to ramp up our portfolio, which we can do so very quickly, it's a positive note that we do it through and with the clients of these companies. We do not finance customers as other retail models, but we do finance clients, okay? That means we have some certain eligibility criteria, which has to be very flexible. If not, we would leave out every farmer. Like for example, they have to work for more than 1 year with the companies, and the companies are also responsible for the client meeting that eligibility criteria. In the end, what happens with that is that we have a reverse scoring model, as I like to say. A usual bank takes a lot of time, 3 to 6 months, to score a company. They ask for a lot of information, and many times the credit comes out positive, but when the farmer does not need it any longer, okay? We work in a business model in which you do not decide when you want, for example, to sow or work the land. You do it when you can, okay? And that's part of the explanation why vendors account for 50% or 60% of the lending in this business, input suppliers or off-takers, okay? So we do work with them, and we tackle the knowledge of the smallholder, as you asked before. We own the data. About data proprietary, we own the data, but we have strong contracts with the vendors. They share a lot of data with us, which is key for our underwriting model, and we do not sell it. I think if we want to be successful, this is one of the key things I've seen a lot in AgTech. We've started working in big data and the accumulation of data. Have a look to Brazil. Many of the companies that have emerged in the last 24 months as agri-fintechs pivoted from a big data model. They couldn't monetize on that. Nobody was going to pay for that. In the end, I think that's because the data is owned by 5 or 4 companies. When you go to every sector, fertilizers, seeds and trades, ag chemicals, these are oligopolies, okay? So the data is owned, the data is well known. You're not speaking about millions of farmers, but thousands in the end, from my point of view, from Pago Rural's point of view. And you have to work alongside them, and they have to share the data. If we have a data selling model, I think we couldn't be able to be successful, okay? And we do work with credit unions and cooperatives in the end, but I think the low-hanging fruit for Pago Rural, and I've heard this in the panel that was before, let's go straight forward. We have a very big opportunity in 5 major crops in Latin America, okay? So that's $100 billion opportunity. Okay, can we finance coffee? Yes, we do. Can we finance sugarcane? Yes, we do. Can we finance shrimp in Ecuador? Yes, we can. But can we do so successfully on one time? No, we can't. So the first move going forward, and the biggest constraint we find in the past year, is the volume of credit. Development banks are really good, but they are many times more expensive and difficult to bring on board than commercial banks or hedge funds in our examples in Argentina, for example. So we have to go forward. Regulatory framework, financial protection, etc. That's a very important part from any fintech. That's permanently evolving. But then it's very easy for us because we work with clients, not customers. That's a big difference. We're compliant with data protection. We have onboarded 17,000 farmers in Argentina. I'd say we merely had 80 to 90% of 5 major crops production there. So this is not a matter of millions of people and how to address their data. This is a matter of how do we make queries accessible, how do we make a good framework and security for investors and bring them together on board. So it's 2 different areas, fintech and very sophisticated and boring maybe legal matters, tax matters, and investment matters regarding institutional investors.
Okay, thank you very much, Patricio. So we ran definitely beyond the schedule. Unless there was one question that came through the chat, and I think this was more for Andrew. I can't remember now exactly what the question was, but there we go. So the question, Andrew, there is a question here. Perhaps you can answer. This is whether you have SME financial partners for rural farmers in Uganda, and how can they be contacted? Maybe it's not straightforward to answer this in this setting, but if you want to just give a quick...
Yes, we do have financial partners who work with rural SMEs and cooperatives, and I provided my email. So if David Kitongo can reach me after this session, I'll be happy to share those contacts with him.
Okay, thank you very much, Andrew. So this brings the panel to an end. I hope you have found it of interest. I would like to thank the 3 panelists, Andrew, Harry, Patricio. Thank you very much for your interesting presentations and for addressing the questions in great detail. All the best.
Thanks a lot to you and the audience.
Over to you.
Yeah, hi, just